Good evening, everyone, and welcome to our introductory level session, I'll call it, Why Invest in Stocks. My name is Ann Cunez, and I'm the Education Program Manager with Better Investing. I'm joined this evening by Mr. Ken Kavula. He's a volunteer, president of the Mid-Michigan chapter. Hello, Ken.
Hi, Ann. Glad to be here.
We are going to begin this Why Invest in Stocks. As I indicated, it is introductory level. We just want you to take a couple of quick takeaways probably from this class. First, we want to make you aware that investing in stocks is a good thing. We hope you go away with that. And the second most important thing is a realization that maybe Better Investing can help you learn how to successfully invest in stocks. So why don't we get started, Ken? And we have a disclaimer, as always. I don't really think we have a lot of stock references tonight, but if we do mention any, everything we do mention here, they're not stock recommendations. Everything is for educational purposes only. We never make any recommendations for purchase or sales. We are in the business of education. All right, so let's look at some of the goals that we have for tonight's class. First of all, we're going to stress the importance of making some goals and a plan to go with it. We all know that you can't get anywhere without a little bit of a roadmap. If you don't know where you're going, you never are going to get there. So make those goals and put a plan in place. Next, we're going to take a look at or introduce you to the concept of compounding. And just real briefly, that's the idea of generating more earnings from previous earnings, money making money, and the realization that here time is on your side. The next goal we have is to look at and understand why a long-term view in investing in particular will help you minimize your risk. And we will have some data for you to consider with that. And finally, we will take a look at Better Investing. We will introduce you, if you aren't familiar with Better Investing as an organization, and introduce you to the fact that we have a powerful set of tools to help people become better investors. We help people learn how to manage their money. As our tagline says there, we have been empowering investors for quite a while, and that's what we hope to do for you tonight.
Well, Ann, the first thing we want to talk about this evening is financial freedom. I think this is something that we'd all like to achieve. And plotting a course to financial freedom is one of the major things that we encourage our members in Better Investing to do as they begin to put a portfolio together. First of all, we need to understand what financial freedom means. And from my point of view, financial freedom can mean a lot of small things, and it also can mean some very large things. Financial freedom to me means the ability to have a full set of health insurance in place and not worry about whether or not I have to pay any significant amounts of money in the case of something really serious happening. Financial freedom also means, for me at least, the ability to eat steak when I want to eat steak and to sip a good martini if I choose to sip a good martini. I want to be able to help my grandkids, and my wife and I would like to be able to travel. We're not going to be extravagant in those trips or do anything that might call for us to be gone for 15 or 20 weeks. We're not going to rent a chateau in the French countryside, but we would like the ability to take off when and if we wish without worrying too much about what the costs are going to be. How about you, Ann? What does financial freedom mean to you?
I really gravitate towards that last item. I don't like to worry about money. I like to know without really thinking about it that I've got enough money to handle all of my bills, and if I have a broken refrigerator one day, that I can go out and buy a new one without really worrying. And I also do like to travel. You know, Ken, that I do have a new grandbaby, and that grandbaby lives all the way across the country. So I want to be able to schedule 3 or 4 or 5 airline trips in my future in the course of a year or until my daughter gets tired of seeing me. So that's what I call financial freedom.
Well, in addition to having this freedom to do the kinds of things that you desire, you have to be able to differentiate between definite wants and things that you definitely need. And as we look at some of these lists of things that I've put on the screen here, I think it's fairly easy for you to separate these things into two piles. Your financial freedom plan is going to have to make sure that you cover the needs first, and then you cover as many of the wants as you possibly can with your financial plan. Travel, dining out, a new car every 3 years, these are probably wants as opposed to needs like health insurance, property insurance, prescription drugs, and food. So we need to be aware of the difference between wants and needs, and we need to factor all of those differences into our financial freedom plan.
So how are you going to reach these goals? We all hopefully agree at this point that we do have a goal of achieving some financial freedom, whatever that means for you, getting some money in a bank, but you have to have a plan to reach that goal. Now, we've brainstormed a bunch of different ideas up here. There's a lot of different ways that people will try to reach their goals. I think some on this list are probably a little bit better than others. I tend to gravitate towards fully funding my 401k. I have created and continue to fund an IRA. I like to have my investments, so I gravitate towards those. I'm not sure about this Powerball lottery. I'm not a very lucky person, so I don't think that would really work for me ever. But some of these are probably better plans than others. Wouldn't you agree, Ken?
Absolutely, and I think some of these ideas involve a little bit more risk to your well-being than other ideas. This whole concept of risk is going to be threaded in and out of our discussion this evening because how much risk we can actually tolerate and how much risk is carried by different ideas is something that has to be considered. I know that my dad, for example, would never come anywhere near the stock market, but he was extremely comfortable in continuously buying United States savings bonds and putting them away for his retirement. Granted, it gave him a lot smaller return, but that was within his comfort zone. That was the kind of risk he was willing to take with his money. I've heard people tell me that when they retire, they're going to move to Mexico or the Caribbean or some country where the cost of living is extremely cheap, and that's how they're going to reach their financial freedom. I'm not certain that that's for everybody, but I do understand the philosophy behind it at least. But if your plan involves a lot of chance, if your plan is based on something that has a low probability of actually happening, or if your plan is based on something that is a pretty narrow foundation to its well-being, then I think you need to reconsider and not forget about some of the more traditional ways to reach your financial freedom to fully fund your future. We need to
The
ask
next
ourselves about control. We need to ask ourselves when we're looking at these different plans, how much control do you actually have over various pieces of the plan? For example, as I glance down this list, I look at the IRA and the 401k, I look at the savings accounts and the bonds, and I know that I have a little bit of control in deciding how these investments are going to be made, and I have a little bit of control in watching what they're doing, evaluating how they're doing, and then keeping my money in a place where I'm relatively comfortable with the risk incurred. And are you counting on an inheritance?
I am not. And if you are, you might think that is something you have control over, but I'm here to say that sometimes that can change. As I said before, I'm definitely not thinking about that lottery. And even when you look through this list, Ken, and you look at something like passbook savings accounts or just a savings account. While you do have control of what money you put into that account, and it's your decision on investing in a savings account, and it is a form of investment, you have virtually no control on the interest that you're going to receive. That's determined by the bank, and you will just be the recipient of whatever interest rate they come up with. You have
Right.
control of what you put into it, but not so much of what comes out, I
I
guess is
agree
what I'm
with you, and
saying.
it's probably a very safe investment, the fixed income
Absolutely.
savings account. But I think Mr. Bernanke at the Federal Reserve has basically told us that it's going to give us virtually no growth in the next couple of years at least. Most of us understand that putting money in a savings account today is yielding minuscule returns.
Yeah, very small. So the question is, and I hope we've made you realize that you need a plan. Hopefully you've got some kind of plan to cover your wants and needs and then go a little bit beyond that so that you can start making a savings plan to have a long-term financial freedom. I'm going to suggest that whatever plan you have, and it's right on there, it's the second one, the plan should include a written budget or a budget. Some people aren't good at writing them down, but have a budget. Know what's coming in, know what's going out, and work with what's left over to make that plan towards financial freedom. I really think that has to be part of any future plan if you really want to see your savings and your wealth grow.
I'm also going to suggest, Anne, that any plan that you're putting together should probably be based on a combination of a couple of these different strategies. Those of you that are just counting on living on Social Security throughout your retirement, for example, probably have a plan that's a little bit too narrow to give you full financial freedom.
I believe this completely because this is the words I've lived by my entire life. Whatever plan you take, remember you've got to pay yourself first. And what that means is that you take some of what your income, what you're bringing in, and don't spend it all. Put some away. Put some into that investment vehicle, whatever it is, and pay yourself first. And we're calling that investing in your future. It's a very, very important concept.
And if you can pay yourself with pre-tax dollars, dollars that you can put into a 401k or into an IRA, if you can put that money in there before taxes have been paid on it, you probably have the chance of allowing that money to grow for a long period of time and give you a better chance to have financial freedom as you move into your 60s and 70s and live a long, healthy life. We're going to talk a little bit about compounding, and we'd love for you to practice using that question box by answering this question. If we gave you the choice of taking $1 million in one lump sum or a penny a day doubled each day for 30 days, which investment would you choose? Take a moment and type your answer in the question box. Let's see what some of you are thinking.
I have to say, Ken, that seems like a trick question of some kind because $1 million, who wouldn't want that? That sounds pretty good.
Are you getting any answers in?
We are getting a few answers. We have a 1 cent doubled. Somebody does want the $1 million. A lot of people take a cent. Somebody's asking, do we get that million in a lump sum? So there, mostly we have the cents, but there's a few people that are taking that million. So why don't we
Well,
go
let's
through this math?
Sure, let's talk about the compounding. On the first day, we'd give you a penny, or we'd give you the lump sum of $1 million. On the second day, we'd give you 2 cents. Nothing to the people that got the million. You've already been paid off. On the third day, you get 4 cents. On the fourth day, you get 8 cents. On the fifth day, you get 16 cents. And we continue this pattern for 30 days. On day 29, we would hand you $2,684,355. And on day 30, we'd add another 5+ million to the pile of money that you've been accumulating. You've just witnessed the power of compounding. Now, in this example, the compounding is fast and furious. It's 100% and it's being compounded daily. In other words, we're doubling your money. That means you've gained 100% of what you had, and we're doing it on a daily basis. I guess a reasonable question to ask is, what kind of growth might be more reasonable to expect from an investment? And go on.
Well, we'll answer that in a minute, but before we go there, I just want to, because this is such a powerful concept, and we started out with 1 cent and 2 cent, and on that first slide, the last slide, we were up to what, 16 cents or whatever, and then suddenly we get to $5 million, and that just, the idea of compounding is the idea of your money earning interest on that interest, earning money on that money. So it's building. That's the idea of compounded growth. Now, as Ken was just saying, 100% every day is not a realistic return. But how about doubling our money in 5 years? Better Investing does believe that on average, for an average 5 years, not every 5 years, that we can double our money in 5 years. And what percentage would that be to double our money in 5 years?
Well, I happen to know,
the
Ann,
answer.
I happen to know that if you're paid 15% interest each year, then over a 5-year period, your money just about doubles. Why don't you all take your calculators, if you have one handy, and punch in $100. Now, most of you know how to figure interest. You could take the $100, you could figure out what 15% interest would be. That would be $15. And then you could add it to the principal of 100 and get the next year's beginning total of $115. Another way to do that is to multiply the beginning principal by 1 plus the growth rate. In this case, the growth rate was 15%, so I'm multiplying by 1.15. If I do that for 5 years in a row, I should be able to see what the compounding accomplishes. And here's the arithmetic right here on the screen for those of you that don't have a calculator handy. Notice we're starting with $100, and at the end of the first year, at 15% interest, we end up with $115. We start the second year with $115, and here we are multiplying by 1 plus the growth rate. Remember, the growth rate is 15%, so we're multiplying by 1.15 to yield $132. That's what we have at the beginning of year 3. At the end of year 3, that grows to 152. In year 4, we see the 152 grow to 175, and in the 5th year, we see the $175 grow to $201, a more than doubling of the investment at 15% over a 5-year period.
And I just want to point out, Ken, that while this is all true and it's showing the power of compounding, the power really comes into play in the later years. Look at our year number 1. We earned $15 on our $100. Well, by compounding, towards the end, we earned $26 in year 5. And remember our penny example? In our very last day, we earned $2 million with the 1 day 100% compounding, doubling. But it's the time that you spend doing this when it really, really pays off.
Now, if you think that 15% is a little bit ambitious to achieve for your investment returns, you can do the same kind of arithmetic by multiplying by 1 plus the growth rate, and you can see how long it would take to double your money at various other returns. If, for example, you were going to grow your investments at 12%, you'd see that it would take about 6 years to reach that doubling. And if you were going to grow at 10%, you'd see that it would take a little bit more than 7 years to reach that doubling. Again, we're just multiplying by 1 plus the growth rate, and for every year that we do that, we can watch what our result will be, and we can tell when the doubling occurs by watching the $100 turn into $200. Let's move on to what generates the best returns. And again, we would encourage you to just jot down an answer in the question box so that we can see if we're engaging you or not. We've given you some choices here as to what might generate the best returns, and we'd like you to look at this as what generates the best returns over long periods of time. You know, if we were talking back in 2005, I would bet that a lot of you might be tempted to say that real estate generates the best returns over extremely long periods of time, especially those of you that lived in really hot real estate markets, perhaps like California markets, something along those lines. But after the latest recession, I hope that most of us have begun to understand that real estate has its ups and downs just like any other investment.
We don't have a lot of answers. It's a tentative group. Maybe they're just not sure what the answers are, but I will tell you, universally, the answers that are coming in, the people that are answering, are telling us stocks are the very best generator of some better returns.
And I would tend to agree, and I think over very short periods of time, maybe a year or two, some of the other investments might very well outperform common stocks. But for long periods of time, I just don't think you can beat the return that comes from investing in common stocks.
And in fact, just a little piece of information that we'll probably draw on later, you know, over the long term and over history, common stocks, and it depends on which study you read, but they have returned 8 to 12%, and again, it depends on what you're reading and what you're using as your reference, but that's a really good long-term performance, 8 to 12%, somewhere in that area.
Here's some data that you might be interested in. The graph begins in 1925, and it compares 5 different asset classes, 4 different asset classes actually. All of the classes start with $1, and we can see how they've grown through 2011. The very bottom line, and they're labeled pretty clearly, the very bottom line, the red solid line on the bottom that I'm following with my cursor right now, is showing what inflation has done. So if we started in 1925 with just $1, it would have inflated to about $12.59. So a 1925 dollar is now worth about $12.50, or at least it was at the end of 2011. We compare that to short-term treasury bills, and short-term treasury bills are usually defined as treasury bills that have maturities of 6 months or less. And we can see that they would have grown from $1 in 1925 to over $20 at the end of 2011. Long-term bonds, and that would be in the range of around 20-year bonds, would have given us a value of $119. But look at what large company stocks and small company stocks would have yielded over the same period of time using the same beginning reference point. $1 invested in large company stocks, maybe invested in some type of an index like the Dow 30 or the S&P 500, which both contain large numbers of large stocks, would be worth somewhere in the neighborhood of $3,000. And $1 invested in a small company basket would be worth somewhere in excess of $15,000. There's just no comparing the stock investment to the investment in bonds or in fixed income instruments. We think that graphs like this demonstrate very clearly that while you can't run away from the times that the market moves in the wrong direction, I think all of you can see the stock market crash that happened in 1929 on the graphs, and most of you can see the stock market crash that happened in 2008 on the graphs. But even though we can't run away from those crashes, we can certainly, over long periods of time, mitigate their disaster by getting large amounts of money out of stocks as compared to the bonds or the fixed income, the other fixed income instruments.
The concept you're talking about, Ken, is one of volatility, really. When you look at those large company stocks and small company stocks, when you look at those lines, you see that there's a little bit more up and down to them. It's not going to return you 12% or 10% every year in a straight line. Some years are going to be up and some years are going to be down. But over the long term, we see that large company stocks and small company stocks, stocks in general, common stocks, have way outperformed these other investments. But you have to remember that with these higher returns, and anybody that's gone through any kind of a class on stocks knows that higher returns usually comes with a little bit higher risk. And that's what we're seeing on that volatility on that chart.
Well, let's talk a little bit then, Ann, about this whole concept of risk. Because if common stock is the best investment over the long term, what is the risk that we submit ourselves to when we invest in those kind of stocks? I've pulled together some data, and the source of the data is at the bottom of the graph right here. We've used S&P returns beginning in 1941. We chose the year 1941 because that's the beginning, in my mind at least, of the modern stock market. It's when the SEC was put into place to oversee the stock market and create some rules for investors. And so we're going to look at what's been happening since 1941. These returns do include the dividends that come from the S&P 500. And what we're looking here is the returns on a yearly basis. And I want you to notice how volatile they really are on a one-year basis. They range from 50 to 60% gain in 1954 to as much as a 30 to 40% loss in that most recent year, 2008. I want you to notice that the majority of the returns are in that 10 to 30% columns, the two highest columns in the middle, but there's a significant number of years where if you were investing on a one-year basis, then you were actually losing money in the stock market. And again, keep in mind how much the outliers, how volatile, how much risk there really is in this market if you're looking at a one-year time horizon. Now let's lengthen our horizon to a 5-year horizon. That means that I won't see 1941 on the graph anymore. My 5-year horizon will begin in 1941 and will include 42, 43, 44, and 1945. So that'll be the smallest number on the graph. I'll have another 5-year block that goes from 42 through 46, another 5-year block from 43 through 47, etc. Notice, first of all, the volatility has narrowed. If I view my investments in 5-year blocks of time, first of all, I've reduced the number of years where there's an actual negative return, but I've also reduced the volatility. The most volatile year or group of 5 years ends in 1999 with a 25 to 30% gain in the market. let's do one more iteration of this same idea, and let's look at 10-year blocks of time. In other words, let's focus on becoming long-term investors, investors that are willing to keep their money in the stock market for 10-year blocks of time. When I do that, first of all, I notice that the smallest number on the graph is 1950. That's a block of time that begins in 1941 and goes through 1950. The next block of time would be starting in 1942 and going through 1951. And notice that I've reduced the number of negative numbers on the graph now. I've reduced them to only 2 blocks of 10-year time. Now, they happen to be very recent years. We went through a terrible time in investing in 2008, 2009, and the 10-year blocks of time reflect that fact. And yet the volatility, the number of times that we get outside of positive returns are really very rare compared to history itself. We hope we've convinced you that investing in stocks gives you some of the best return over time. It does involve some risk, but we are willing to take that risk to get the return. And we're urging you to become an investor. We think that's the key to your financial freedom.
And then the question becomes, what kind of investor will you become, or are you? Because there are different types of investors. And we can talk about a few different methods here. You know, we have a fundamental methodology, which means that these investors look at the fundamentals of a company, meaning the sales, the earnings, the growth of a company. They look at the underlying basics of the company. There's another method called technical investing, and this has to do with price movements and trying to predict where the next price movement will be based on past charts and past history of prices. And there's always speculative investors who are, you know, maybe hearing about the next merger, the next story. There's different methods. The important key here is that really people can make money using all of these methods. We're not here to tell you that there is only one way. There are several ways to make money in the stock market.
Once you decide on a method, and again, better investors, people that belong to better investing are fundamental investors, but once you decide what method is going to work for you, there's various orientations within the method. You could be focused on value, and value is when you're looking at stocks that you think have been beaten down by the market and that are not being traded at a value that reflects what they're actually worth. You could be an income-oriented investor, and if you're an income-oriented investor, you pay a lot of attention to the dividends that a stock might pay on a yearly basis. You might be a growth-oriented investor, and you focus on companies that grow their sales and their earnings in a regular, consistent way over long periods of time. That last method of investing is really where better investors focus a lot of their efforts, although you'll hear many, many times that better investing members are focused on growth with an eye towards value. We're always looking to buy the best high-quality stocks, and we're looking to buy them at a very reasonable price so that we have a distance, we have a chance of making some money through stock price appreciation. Again, people make money using any and all of the investing methods and orientations.
You know, there's a few keys to success here, and that is mainly pick a method and an orientation. Pick what's going to work for you and stick with it. We don't recommend that you're switching from type to type, Become a fundamental investor if you want to follow the better investing methodology and stick with it. Don't be changing gears all the time. Go
And
ahead.
once you pick a method and orientation, we urge you to learn the disciplines involved. Some of the methods of investing, especially if you're a technical investor, for example, are quite complicated and have a high learning curve attached to them. But if you're going to become a successful disciple of any particular method, you need to learn the discipline itself. Once you learn the discipline, you need to practice. And we've written on the slide practice a couple more times. You need to continually be practicing because that's the only way that you're going to get better. We find that people that follow the better investing methods get better and better throughout their entire investing career. The more they practice, the more they talk to other investors, the more they use the tools that are provided, the better they become at choosing stocks that fit the portfolios that they're trying to put together. And finally, we ask our investors to maintain the discipline, whatever it happens to be. Some of the least successful investors that I watch on a regular basis are people that tend to jump from style to style to style. They're never quite sure what kind of investor they are, and they're always sampling a little bit of this and a little bit of that. We find that those people are usually not very successful at putting together profitable portfolios.
Yeah, it's a problem because, think about it, Ken. It's human nature, I think, for us to want to jump ship when things aren't working out well. Okay, so you picked a few stocks using this methodology, and maybe they didn't do so well right out of the gate, and somebody's going to say, oh, this isn't working for me. I'm going to go and do something else. Well, more than likely, and it is human nature, that's often the worst time. You got to stick with it, practice it, give it a chance. As we said in the earlier slides, the stock market is not a straight up guaranteed success, 15% year after year. It's volatile, and sometimes it's a timing thing when you just come in at the wrong time, but over the long term, it does succeed for you.
And I've been investing for a long, long time, and this idea about jumping ship reminds me of what was happening in the late 90s when we were having an extreme boom in tech stocks. The prices for anything with a .com attached to the name of the company were booming, and stocks were just going through the roof. They weren't selling very much in a lot of these companies, but the stock prices were just ballooning way, way out of any relationship to sales or to anything else. And I was listening to many people tell me that my method of investing was old-fashioned, it didn't work anymore, and I needed to discard that particular method. I remember, however, that after the bubble burst in 2000, and after people woke up to the fact that many of these companies really were kind of worthless, we got back to the idea that the more things change, the more they really stay the same. And we discovered that some of the tried and true methods of evaluating stocks and doing investment still stayed the same. We still needed to look at the underlying fundamentals that were involved in keeping a company strong and on track. So I'm ready to
I
not.
remember that,
Yeah,
Ken. Do you remember when everybody said it's not about earnings anymore, it's all about eyeballs?
yeah.
About
And
eyeballs looking at the
and my
websites.
favorite sentence was always that PEs no longer matter.
And PEs no
Uh,
longer matter.
yeah.
Right,
So
right.
I'm not willing to abandon my methods or my particular orientation for investing because I've been very successful with it, and it's treated me quite well during down markets and during up markets. I've learned the methodology, I've learned the discipline, I've practiced it, I've taught it to many, many people, and most importantly, I've maintained that discipline, and it's treated me very, very well.
Well, at this point, we want to give you a brief introduction to Better Investing. We have been providing investor education since 1951, and our focus is on that fundamental investing. We are trying to buy high quality growth companies at a reasonable price. So we've got an eye on growth and we've got an eye on value. The methodology that we use, we are goal oriented. We believe that through prudent stock picking, an everyday Main Street investor can beat the market, meaning you can do better than the market averages. We put a number on that to double our money every 5 years. That's approximately 15% every 5 years on average. But really, it's our goal to do better than that overall market. And I said earlier that that's around 8 to 12%. So if the market is returning 10% in a given year, well, maybe we can do 12 or 13. And that is really, it's a wonderful goal to have, and it's achievable, and it's very difficult. I will point out, if you look at some of the mutual fund returns, mutual fund manager returns, it's a very difficult thing to do. But we find it's not that difficult when you do have an eye on high quality growth, buying that at the right price, and keeping that long-term focus.
Our method is sometimes called sleep at night investing. It's definitely long term, but we're not buy and forget investors. We don't suggest that you buy a stock and put it away, hold it for the next 30 years and forget about it entirely. We suggest that you buy great stocks and you buy them at very reasonable prices, and then you aim to hold them for as long as they're still good investments. There's nothing that says that if a stock has everything fall apart a year from now or 6 months ago, 6 months from now, that you can't sell it. And there's also nothing that says when a stock gets a little bit ahead of itself and you have a better idea that has more potential as measured by the tools that you're going to be using, there's nothing that says you can't sell the one and buy the next. Long term means that we're looking to keep a portfolio moving forward for a definitely 5 or more year period of time. We're very conservative. We purchase companies with consistent histories of growth and high quality. And the key word in that is consistency. We want companies that just keep growing at a real strong, consistent number. And we're relatively confident that if a company has grown consistently for the last 8 or 10 years, that there's a very good chance that it will continue to grow consistently for the next 4 or 5 years.
You know, we like to talk about our success because those of us that have been doing this for a while know that this works. We know that we have success in our personal portfolio. But we do have a way to kind of shout this from the rooftops now and share this information with the world, and that's through this Better Investing 100 index. This is an index. It was created in January of 2008, and it's an index really kind of represents some underlying holdings. And the underlying holdings for this is the top 100 holdings of our investment clubs in Better Investing. And this is not a tradable index. Some of you may know about various tradable index. It's non-tradable. It's information only to help us track the performance of these stocks. But this index, it's rebalanced at the beginning of every year. So once a year in January, it's rebalanced. It's known by this ticker symbol that you can look it up on Yahoo, BIXX, or some other places. And we have a chart here that kind of demonstrates. This chart is from MSN, as you can see. I pulled it. And it's a little bit busy, but let's just kind of go through here. The blue line that you see on the top is the Better Investing Top 100 Index. And it's being compared to several other well-known indexes. And if we start at the bottom in gray there, that's the S&P 500, which is basically one of the leading indicators for U.S. equities, large U.S. equities, stocks. This is a larger companies in the S&P 500. Now this is more diverse. Maybe you've heard of the Dow Jones Industrial Average. That's only 30 stocks. They are also very large stocks. So that's a smaller subset, but that's the Dow 30 that you see there in purple. The one that's in tan, that's an index known as the Russell 2000, and that's an index that represents and tracks the performance of 2,000 smaller companies. Now, when you see on this chart, and this is over the 5-year period that the BIX, the BI Top 100, has been available, you can see that the BIX has outperformed all of these other indexes over this 5-year period of time. Sometimes it's been close. As you look in that 2011 period, the Russell 2000 and the BI Top 100 were kind of neck and neck. Past performance, I'm not going to say guarantees future results, but we're a little bit proud of this. Our investment clubs are making some smart decisions, so we wanted to put this up here.
And we want to also emphasize that we're not claiming that stocks don't go down. We know that stock prices fluctuate. Even the very best selection of stocks still will take a dive when you have something happen like happened in 2008. And you can notice over here in the 2008, early 2009 period, you can notice all the indexes taking a dive. What's significant, however, is once they hit bottom, the VIX seems to recover more quickly and seems to at least match the small stock index or surpass it as we move into the end of 2012.
Let's get into the principles of better investing. We have 4 basic principles, and this first one, invest regularly, is an important one. I'm going to tell you right now that the best time to start investing was yesterday. It's always previous to now. But if you haven't done it previous to now, the next best time is now. Just start doing it. And we say invest regularly, whether the market is up, whether the market is down. Don't try to time the market. We have this saying that it's time in the market. I don't know if we have that. It's probably not original. But it's time in the market, not timing the market, that will make you the most money.
And this regular investment schedule doesn't have to be once a week or once a month. It could be quarterly, or it could even be twice a year. But put yourself on some type of a schedule, and when you hit the time when you're supposed to be investing, then invest whatever sum it is that you've allocated towards your investment. Timing the market just doesn't work. We also suggest that you reinvest all of your earnings. Take the dividends that flow from the stocks that you own and reinvest them in the market. We're not suggesting that you necessarily reinvest them in the company that gave you the dividend, but we are suggesting that all your dividends be captured and reinvested into your portfolio so that your portfolio continues to compound. There's that word again. It's so important that we compound our earnings. We urge you to diversify. I think some of the charts that we've shown you this evening make a really great case for not only investing in large stocks, but maybe taking a real solid look at medium-sized and small stocks as well. I think that one chart that showed the Russell 2000 greatly outpacing the large stock index, I think that's a good argument for making sure that there are some small stocks in your portfolio. I think we can make a great case that the more diversified your portfolio is by industry and by size, the more successful your portfolio is going to be.
It's that concept of don't put your eggs all in one basket. The 4th principle is really kind of our gold standard, and we recommend that you invest in quality growth companies. We teach you how to identify quality and growth, and we try to make sure that you don't pay too much for these companies. But we believe that if these are anchoring your portfolio, these quality growth companies, your portfolio will grow and you will be a very happy investor.
The tools that we use are the Better Investing Stock Selection Guide, and we have a couple of variations on actually using the tool. We have a standalone product which resides on your computer, and we also have a product that resides in the clouds called the Online Stock Selection Guide. Either one of them is a great tool, however, in helping decide, first of all, whether you have a high quality growth company, and second of all, whether it's trading at a price that's reasonable and will provide you with enough room to make a profit in the stock.
You know, we have to add our judgment to the stock selection guide. Our judgment, adding our judgment is key to making the necessary projections and really to help us determine whether or not that stock is selling at a reasonable price. For those of you that stick with us and maybe want to sign up for the introductory series that we're going to talk about at the end of this, the introduction to the SSG, this is the topic that we will be covering. We'll be learning all about the stock selection guide in great detail in these classes.
This is the methodology that we would expect you to learn if you want to become a fundamental investor using the Better Investing methods, and this is the methodology that we would expect you to practice and then do some more practice on to turn you into a good, solid investor.
Investment clubs, they are a big cornerstone of who we are and where we've come from. We believe in clubs. We believe that they help individuals learn how to study stocks. You gather together, you meet and invest on a regular basis. By pooling your money, you've got a little bit less to get started. You can get started with $25 a month or $20 a month. Pool your money to make those investments and get a portfolio to manage. It shares the responsibilities with other club members and you learn from each other. It's an excellent learn by doing program. Investment clubs work. I am an example of that. I was introduced to Better Investing through an investment club. I didn't know who they were. I was invited to join an investment club. I joined, I learned, I embraced it, and I became a successful investor.
I think what's so great about a club also, Ann, is that when the market's not doing so well, they provide great support. They allow you to lean on each other and help you remember why you're investing. And when the market's doing quite well, it's a wonderful place to meet on a monthly basis and celebrate your success. I belong to a number of investment clubs, and it's a great way to not only meet some social needs, but to share the responsibility for doing the kinds of work that goes into maintaining a portfolio.
Learn How with Better Investing talks about a lot of resources, and these are available to both members and non-members alike. So all of these are available for free. There may be a fee for some of the local chapter classes, and of course there is for the national and regional conferences. But these top bullet points are all available online and available free. We support all of our investors, individual or club members, through the use of our tools, our online tools that we have. Our tools and our data are very powerful. This is our stock selection guide and other tools such as the stock comparison guide. We've got mutual fund tools, which is outside of what we're talking about here. But we've got those tools plus the data that fuels them.
We should also emphasize that because we're a nonprofit, our tools and our data are available for very, very low prices, especially when you compare the cost of similar tools or similar data to for-profit sites. It's a way to get involved in investing for a very small start fee and learn an awful lot about how to become successful without putting an awful lot of money up front.
we've intrigued some people, Ken. We've got them thinking about how can I do this? So I want to get through these next couple slides because we've got a series of classes. This was the first. We have another introductory session, and that's called Understanding the Jargon. Ken and I will be back here, and we will be teaching some and introducing some very basic vocabulary and concepts that you will come across as a new investor. This is a recommended prerequisite for this series that you're seeing the slide on right here. We do have this Introduction to the Stock Selection Guide series. It's 5 sessions. Ken and I are both teaming up to teach this whole thing. We do like teaching with each other, so we have fun. It's a low cost. They are online. If you cannot make any of them, don't worry. They're all recorded. If you'd like to sign up, there's a URL at the bottom there, betterinvesting.org/introssg, and you can get all the information you might need on that.
One of the key things about this series of classes is that we're going to do a lot of practice. We're going to look at actual companies, we're going to use real data, and we're going to ask you to do a little bit of outside homework, not a lot, but a little bit of outside homework so that you can begin your practice. And we hope by the end of class 5, you'll be at a position where you can do your own elementary stock selection guide and draw some pretty decent conclusions about whether a stock is a good high quality growth stock and whether it's available at a reasonable price for purchase.
And the tool we use, I'm just going to point out, is the online stock selection guide, and the stocks that we will be looking at, these companies and the tool will be available through the free trial version. So even if you're not a member or if you don't have access to any of the tools, you'll still be able to do the activities using the free trial version of the online SSG, which is fully functional.
Here's our email addresses. If we haven't gotten around to answering your question this evening, please drop either one of us an email. We'll be glad to respond and try to get you a reasonable answer. Ann and I always enjoy teaching with each other, and we always enjoy working with true beginners to the stock selection guide. It's kind of our mission to bring people into the fold and to teach them how to gain control of their own financial future. It makes us happy when we hear people say that they feel confident going forward in controlling their finances. So, Ann, I thank you, and folks, I thank you.
I'm just going to add to that, Ken, I absolutely agree, because there was somebody at some point that helped you and I learn this. I know there was, and it meant so much to me, and I do love helping and teaching the newer investor.
Bye-bye, everybody.
Good night.